Okay, let's kick off with rule number 3, and that's learn how to read price charts and learn how to read them well. And I don't mean just the basic stuff. Look, everybody should know the basic stuff like this, which shows you on each bar the open, high, low, close. Of course, we want to know that, and of course we want to know it because we can see the general direction of a price, and we see a lot of information in one go, a heck of a lot more than we'd normally see through just looking at price data or fundamentals. The reason we look at this kind of material is because we want to be a little bit more analytical than just simply looking at something like that. Why do we want to look at price charts? Well, because one of the questions we need answered as private investors is we're getting in too late. Imagine this image is a share price. It's going down, then it starts going up, and then falls off. It's just basically it's supposed to be a stylized version of a typical share price. The reason I've done it so simply is to prove or to show and illustrate one particular point, which is this. One key problem as investors we always have is we get our entry too late. We get in just as the price is about to peak. It might go up a little bit more and then drop off. Worse still, we get in and spookily it just drops off as if the market knows exactly what we're planning to do. How do we solve the problem? How do we get in a bit earlier? However, my research and the research of many professional investors shows we don't want to get in too soon. We don't want to get in while the price is still falling, still going downwards. If we get in, say, at a point X, the problem with that is the price might not just be about to turn, it might continue lower. Okay, so if we don't necessarily want to get in at a point X while the price is still falling for fear it might go down rather than turn the corner and go up, and we don't want to get in at a much later point all the way over here because it's too late, then where do we want to get in? Well, the answer is point Y. Fair enough. That's all very well illustrating that on a simple stylized diagram like this. But how do we find point Y? Well, that's where price charts come in, and I'll show you some of the techniques where we try and find point Y. Well, what's so special about point Y? Well, I'll tell you what's special about point Y. First of all, we're not getting in too late. We're not getting in too early. For obvious reasons, we don't want to do those two. We're getting in at a point where we expect fairly early on there's an increased probability of the price moving up. Now, that's not going to be 100% probability. What might happen is we get in at a point here where the price has been falling, just risen a little bit, but it then goes off again. That can happen. However, what I'm telling you is my research, the research of professional traders shows that this situation is the one we want to avoid. This situation of getting in too early isn't a situation we want to avoid. What we want to try and do is get in at a point here, not because we've got 100% probability, but by simply even avoiding these two situations, we increase the odds of our trades being profitable. Now, they might still dip off soon after we've bought them, but we can increase the chances of our trades being profitable to about 7 times out of 10, as opposed to maybe only being right 4 times out of 10 instead, or worse still, well, sorry, not worse, but or equally badly, just about being right 5 times out of 10. We're trying to get to 7 out of 10. Okay, well, that's a bit of the theory. How do we ensure we get into a position around here? Well, that's what I'm going to talk through in very brief outline in a second, and that's why I mentioned charting is important. We look at what might at first glance seem quite technical price charts such as these. Trust me, once I've taken you through them, you'll be able to read stuff like this in 3 seconds flat. I tell you what I do, I will go through price charts like this, say of the FTSE 100. I'll go through 100 charts by clicking on my computer software. I'll spend about 5 seconds, 3 seconds on each one. I'll then, on a piece of paper, narrow down the 3 to 5 which look particularly interesting, focus in on those, and then spend a longer period of time on those 3 to 5. But it allows me each evening to scan through 100 stocks. You can't do that if you're looking at annual reports or if you're looking at Investors Chronicle or some magazine to try and give you some idea of stock pick. You can do it if you know what you're doing, so you're empowered to save time and make money because you're getting in at a better level. Now, there are risks, of course, because none of this is guaranteed to give you a 100% return. Of course not. We're just trying to increase the odds of being on the right side of the markets and reduce the odds of being on the wrong side. What does a technical chart such as this is part of my trading system. I'm looking at the price charts here. I'll run through some of the jargon very briefly. These are Bollinger Bands. They relate to price volatility. I know it sounds complicated. Trust me, you don't need to know how things work. What you need to know is the rules which relate to them so that in a few seconds you can benefit from the time saving and the odds of knowing the price is in your favor. But I just want to illustrate some of the elements that I look for in my own trading. Bollinger Bands, I already mentioned. Price charts. I'm then looking at the moving average convergence divergence. I'm looking at a stochastic oscillator. Very, very brief outline. What I'm actually looking for is to see some kind of bearish divergence. That's where the MACD makes a lower high, but the price doesn't confirm that and makes a higher high. And you can see that there. When that happens across peaks there, it suggests strongly that the next movement lower in the price, maybe a 2-day low, will signal a bearish move. Now, that's all well and good in broad terms. We need to identify it right down to specifics. Is it a 2-day low that we enter? Where's our stop loss? How quickly do we move the stop loss lower? Those are the kind of things which any charting education should teach us. But it should teach us a systematic approach where we can scan through, save time, make money by looking through charts such as this, complicated charts, not just the simple stuff, but be able to look at them readily and easily. But there's another reason why we need to learn how to read charts. Remember I said, how do we know when to get in? Where it's a 2-day low, where do we put our stop losses? Well, let me give you one particular example of why charts are an advantage for professional traders and why they're easy to learn for the novice. We look for instance, trade structuring. I would print out a chart such as this, which is a standard chartered. I've seen a downtrend for a period of time. I've then seen the price explode upwards. Let's say that my technical indicators were positive, the news was positive, and I wanted to get in. Well, the price is at 885 pence over there. That's fine. I've printed out the chart. Where do I put my stop loss? Well, very quick rule of thumb and a little bit of insight. Traders put it at a point where they know that if the price were to get there, then they must be wrong. Think about that for a second. Where would the price have to go so that I know I'm wrong and it's not going to continue upwards, and therefore I should put my stop loss there? Well, where would I know that I'm wrong? What if it goes back beneath the downtrend line? Because obviously if it goes back beneath the downtrend line, then it's not going to continue higher, or rather the odds are against it continuing higher, and I know I'm wrong. So I put the stop loss, say, around there, 849 pence, because if it were to fall back beneath that, it's obviously not going back into its downward trend, and I've just said I'm buying it because I think it's broken the downward trend. Do you see the reasoning? Where would it go were I to be wrong? Were my reasoning to be incorrect? Now, what novice traders do is they just hold on. If it falls, they just think, oh, please God, let it go up, let it go up. They start praying, hoping the price will go up. They ignore it. They let their losses run, and they don't let their profits run instead. So we're looking at price charts to structure our trades. If that's the stop loss down there, the other part of this trade structuring, if that's a nice tight stop loss, is what's that? What's my maximum loss? 885 to 849. 36 pence. That's not too bad. 36 pence as a stop loss, as a maximum risk, is not too bad. But I've got to compare that to this. What's my target? Why have I set that as a target? Well, if you knew a bit more about charting, we'd know that I'm looking at local resistance levels over there to set a reasonable, probable target. Well, if that's my target, then I've got 45 pence on the upside. Yeah? So my reward is 45 pence. My risk is 36. Well, that's greater than a 1-to-1 reward to risk ratio. Good. The odds are in my favor that if I do enough of these, day in, day out, I should make money on probabilities, and trading is about probabilities. Now, I know I've run through that very, very, very quickly. But the reason is, first of all, we're only on rule number 3. We've got a lot to get through. But the other reason is there's a lot more like that. There's a lot more techniques we can learn, bang, 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 one after the other, which save us time, and either make us money or save us money. It's not 100% guaranteed. As I said, nothing in trading is, but it puts the odds in our favor. That's what it's about. We also want to read price charts so we see other ways of looking at prices being depicted. These are Japanese candlesticks, for instance, which is software at the click of a button will depict these. And images like this, dark cloud cover, teach us that there's likely to be a turning point in prices and it's about to go bearish. Wouldn't you like to have that information? Information which other traders, of course, have. And it shows that that is a potential turning point. The doji start is a bearish signal. Combined with this, we could go short the market. Maybe it was a spread bet, £1 a point, £10 a point, heck. 42.10, you go short. Go down to 40.10, that's 100 point, £10 a point, that's £1,000 in the space of a day or so. Of course, you've got to watch out for risks. If it went the other way, you could quickly and easily stand to lose money. But CFDs or spread betting, or if it was just options trading, you can see how that's invaluable information, being able to read charts such as that. Of course, we combine it with other technical indicators, with news and analysis as well. But this is just to give you an overview of why learning charts is, in one sense, a secret. Why do we want to do it? Well, first of all, it's quicker, as I've described. It's working smarter, not harder. You're not reading hundreds of annual reports. You're actually looking at price charts instead. It's accurate. You know what's going on with your stocks without having to rely on rumor, friends, or speculation. You're in charge. You can look at these charts and say, right, I know what's happening. I know why it's happening. What are the kind of questions we need answered if we're going to do this? Well, what are the stock theories best managers use when they're looking at charts? How do they apply them? Which are the free websites? How can we effectively swing trade? Looking at these charts over, say, a week or a 2-week period, how do we interpret them there? Which are the indicators I use? I showed the MACD, but also which major banks use, and how do they use them? What are the trading signals that professionals use? And what about when we're using CFDs and spread betting? Because of course then we're looking to profit from falling prices as well. And why shouldn't you use these indicators in the way the textbooks do? Trust me, the way the textbooks do, and any trader will tell you this, it's incorrect, and there's a reason for that. If it wasn't incorrect, the textbooks wouldn't be teaching you them, they'd be practicing them instead. So we want to use them like professional traders do. It's one reason why we created, as a result of this and the questions surrounding it, we created out of the How to Invest Better series, How to Read Price Charts with Skill. We also incorporate charting in the swing trading and trend following CD-ROMs over there as well, which answer a lot of these questions, and also a special dedicated CD set, 8 CDs on momentum indicators. Now I told you a bit about the rules already, but this obviously goes into a heck of a lot more detail because there's 8 CDs on that. That's all for rule number 3. Next, we're going to go into rule number 4.